And let's discuss the power of margin trading. In other words, the advantages of margin trading. How you could unlock profits, how you can magnify your profits. Essentially, it's a very, very, I think it's a very good strategy if you know what you are doing, if you can manage the risk, if you are experienced enough to handle everything. I think it's very good because many institutional investors, particularly hedge funds, they apply this strategy. They trade on leverage. They borrow money, large amounts, to augment their portfolios. Number one is increase buying power. In other words, it increases your buying power. Let's say you have let's say you have $100,000 and you want to buy above that. You can borrow as much as $50,000 to add up to what you have, making it $150,000 to buy more shares. So it increases your buying power. So you can control larger positions than what you would have with your own capital. So it boosts your ability to have more number of shares. Number two is it amplifies profits. Just as it amplifies your buying power, it equally amplifies your profit. Let's say the profit rate is maybe let's say 20%. If you have $100,000 and you make 20%, that's what? That's $20,000. All right. If you borrow, let's say you borrow $50,000 and add up, that's $150,000, and you make 20%. That would be what? That would be 10% is what? Is 15,000, right? 10% is what? 15,000. 20 is what? 30,000. You make beyond 30,000. Yeah, thereabout. You make around 30,000. Yeah, 30. 10 is 15. 20 is another 15. You make $30,000 instead of $20,000. So in that case, your profit is magnified by $10,000. So it magnifies your profits. Number two is short selling. So margin accounts allow for short selling. That is, you can borrow stocks from your broker at a particular amount, and you sell, and you rebuy those stocks at a lower amount and sell. So you can now pocket the difference. That is what short selling is all about. All right. You may borrow stocks at $100 and sell it at $100. And then when the price drops to $80, you do what? You repurchase those stocks at $80 and give them back to your broker. So the difference is $20. So by the time you subtract fee and other charges, you pocket the remaining amount as profits. That's all things being equal. Let's assume the stock doesn't go high. If you go higher than what you borrowed at, that will amount to short squeeze. Number four is diversification. Borrowing capital through margin enables investors to diversify their portfolios by purchasing additional security. It helps you to diversify further. Let's say your initial capital can buy probably, let's say 5, different companies. By the time you borrow additional money, you can buy as much as 7 or 10 different companies. So you've done what? You've diversified your portfolio. Number 5 is flexibility in strategy. Flexibility is quite a core concept when it comes to margin trading. So margin trading, provides flexibility for implementing various strategies such as hedging, taking advantage of short opportunities in the market, or making large concentrated bets on favorable market conditions. So it helps you to, because of the amount of capital you have that leeway to experiment with strategies you feel will bring you higher returns. You have something you can afford to play with. So number 6 is access to larger investment opportunities. By using margins, investors can access larger, high value investment opportunities that might otherwise be out of reach, based on your capital, you may not be able to benefit. But by the time you consider, the margin, you consider the fact that you can borrow some amount to augment what you have. Then you can go for, expensive stocks or high value assets. So it gives you that particular opportunity to buy or to accumulate, you know, to partake in larger investment opportunities. Number 7 is potential for fast growth. Yes, it gives you that potential for growth. You understand? Just like I earlier explained, given a profit margin of 20%, you could make either $20 or $30 depending on the amount you borrow. So in that case, it gives you an opportunity to grow rapidly. You could leverage these the funds you borrow to be able to grow rapidly compared to if you are only investing your personal capital, your personal money. Number 8 is flexibility in timing. You discover that a margin allows for more flexibility in timing trades, enabling investors to enter or exit positions with greater ease, even when their available cash is limited. So you can take advantage of larger trades because of the additional capital you have. You can you can benefit from investing a large amount of money in a growing stock. The stock is growing rapidly, and you have a large amount to take advantage of that growth. You can go ahead and do it, and then it provides that flexibility to be able to enter a fast growing stock with a sufficient level of capital. Number 9 is compound returns. There's that issue of compounding. If an investor is able to continuously reinvest returns made from margin trades, the compounding effect can accelerate growth over time, potentially magnifying the long-term gains of the individual. At least if you can keep on making money from the amount you borrow, so you could compound that return into something very big at the end of the day. So there's that compound returns you stand to gain. Number 10 is leveraging for margin calls. If margin call is issued, that's due to a drop in the value of the assets or the portfolio. Investors can potentially use their own funds to buy additional securities to lower, at a lower price, capitalizing on market fluctuation. That's if you have additional, because if you have your additional money, I don't know why you would go ahead and borrow in the first instance. But in case you still have, additional capital parked somewhere, when the price drops, the price of the shares you've bought, even with you are bought, in your margin account, when the price drops, you can use your personal account to do what? To buy those shares at a lower price. And when it climbs, you stand to benefit from an outsized gain. Number 11 is better liquidity. That liquidity. Margin trading can provide better liquidity, as investors can quickly raise cash by borrowing against their existing holding without having to sell their assets outright. So it provides liquidity. You have your assets on ground that can serve as collateral, and the market is doing very well. Very easily, you can borrow additional amounts of money, and then that will improve your liquidity to be able to take advantage of opportunities in the market. This can be particularly useful in a volatile market or for taking advantage of a vast, or an enormous upward shift in market prices or in stock prices. So margin trading can be an effective tool for investors seeking to maximize returns, but it requires careful risk management, due to the potential effect of magnifying your losses. So you must take that into consideration.